on the dollar, weak dollar means weak recovery. Explain how destructive that is, and then we'll discuss QE2. And
the world is constantly in a race to the top in terms of there's a limited amount of capital and you got to figure where it's going. And if your currency is weakening, that means you're paying a load that every year the dollar goes down 5% in value. So your investment in the U.S. is going to have to be 5% better than the one somewhere else in the world. And remember, profit margins aren't that big. 5% is enough to sway almost every investment to go abroad. So as we're trying desperately to create jobs here, we're getting hammered on the other side by the capital flowing away from the U.S. And it shows up in the data. Jobs, where is there giant job growth? Well, it's going on in Asia, not in the U.S.
Now, on QE2, what was the point of the exercise? On the one hand, they bloat the balance sheet, but on the other hand, they in effect sterilize it by offering the banks a nice rate to keep it at the Fed.
That's right. I think the Fed, some part of it was desperation. The Fed wanted to do something. The pressure in Washington, there was a intense pressure by politicians, by the White House, on the Fed to say, look, the economy is falling into a double dip. Remember, in the summer of 2010, there were a lot of economists that were sure we were falling back into a double dip because they weren't being allowed to do more fiscal stimulus. I've been surprised, though, White House, even up to today, I was watching the morning TV shows, and they were still talking about the need for more federal spending. And if we don't get it, then the logic went, well, maybe the Fed will do it. We need to do something. And so the Fed said, well, we'll buy some assets. The risk of that is for the next 20 years or 40 years, anytime the economy slows, a president is going to turn to the chairman of the Federal Reserve and say, why aren't you buying assets? And remember, the Federal Reserve is beholden to the political establishment because of the nomination of the chairman. That position is controlled by the White House and with the advice and consent of the Senate, and the same for the governors within the Fed. And that process actually has now extends to the Federal Reserve banks around the country. And so they're beholden, and that means if you have the power, you should use it. Help the country buy some assets. So they start with Treasuries, but why not buy real estate? Right now, real estate asset prices are low. So the argument can be made, and will be, I think, over the next 10 years, the Fed should be out there buying shopping centers. That'd help puff up the price of shopping centers. The Fed today, of course, will say, no, we'd never do that. But then a year ago, they would have said, we're never going to buy Treasury bonds either. So they did it, I think, to respond to political pressure. I'm sure they had some idea that in economic terms it might be helpful if they borrowed from the banks and bought long-term treasuries, though I've never understood. It just doesn't make sense that would be very powerful. And look what happened. We got very little pop in the economy as a whole. I think the equity market would have gone up anyway in 2010, in late 2010, because there wasn't a double dip. Growth was coming back. The U.S. was doing pretty well. So my view is QE2 has actually been harmful to the outlook because it diverted everybody's business acumen to staring at the Fed and saying, what are they going to do next? So every CEO around the country has probably been spending more time on QE2 than on efficiency gains in their own corporation.
So even though the Fed, in effect, sterilized much of that, commodity markets looked and said they'd created the money anyway, distorting the capital markets. Is that why they went up, even though it wasn't thrown out into the marketplace?
I think the value of the dollar is set by your long-term confidence in your central bank. So we had a central bank that went way beyond the normal rules to saying, look, the normal. Let's say what a central bank normally does. It buys Treasury bills, and then banks lend the money. They inject funds by buying short-term instruments, and the banks go lend it, and that's stimulative. Milton Friedman pointed out we ought to be on autopilot because you don't really want the Fed even responding to the business cycle. Well, we've gone way beyond that, I think, into meddling by the Fed. But now, in this latest round, the Fed said we're going to buy long-term assets and we're going to lock up the bank's money for 10 years for some of these longer duration assets. So it's a huge expansion of the Fed's involvement in the economy. And so if you're thinking about the future value of the dollar, you've got this risk that anytime the U.S. gets into trouble, the Fed's going to buy up stuff and put itself at risk. So it makes you less confident in the Fed, and in contrast, more confident in the ECB. Why is it that Europe, with all its debt problems, has the euro strengthening quite a bit against the dollar? Well, it's because their central bank would not do this type of activity.
Pretty grim scenario. In conclusion, is it possible to turn this around the way we did in the early 80s from a decade of malaise?
I'm an optimist, Steve. I think that we could, and we can zero in on a couple of things that could be corrected pretty easily by the president. The president should be spending less money. He should ask for power from Congress. If he's frustrated by his powerlessness over it, ask for the power and spend less. And then on the dollar, the president any day of the week could literally say to the Treasury Secretary and the Fed, I'd rather have a stronger dollar. It'll bring capital back to the U.S. We'll get some jobs. He could say that, and the markets would not stand in the way of that. The market, remember, loves momentum. And so everyone's short the dollar right now. They'd scramble to get long the dollar to start creating jobs here. And so it can be turned around, I think, in a very short period of time. I don't mean to minimize the longer-term problems. We've got a bad tax code. It's very hard for Congress and the White House to work together on fixing it. People know kind of how to do it, but that's going to be a long negotiation. They all agree that we, on the corporate rate, should have a lower rate on a broader base, but you got to work out the details. So I'm not saying that problem can be fixed overnight. And on the spending side, you've made promises on entitlements, and so you've got to gain confidence in the voters that you know what you're doing, and then propose very reasonable reforms to walk some of the excesses back. For example, on Medicare right now, there's nothing in the incentive structure that causes the doctor to want to give you good care at a reasonable price. His incentive is to use as many procedures that are scored well by Washington. Anyway, so we can't fix everything, but we could fix these two problems. The government's spending too much money and has a weak dollar policy. Start there. I think we'd start creating jobs.